Goes to the organizing committee, Rolf, Giovanni Caligari, Ermal Hittay, and Jeromin Zettelmeier and Jakob Funk Kierkegaard. Where is Jakob?
It's there.
Here, yeah. From Bruegel. And I also want to say a big thank you to Maria Kampa and Dragana Popovic for your tireless organizational work. Let me now turn to the final panel of the workshop on the European Crisis Response Framework. The session will focus on institutional matters. What are proposals for developing the EU toolbox further to cope with the current multiple challenges? How to mobilize, this time again, hopefully, the EU's proven ability to activate its strengths and to generate innovative solutions in times of crises? And in what directions should the EU move, using existing institutions, completing unfinished reforms, or do we need to pursue new approaches given the radically changed environment? We're privileged to have with us today Mahmoud Pradhan, to my right, Head of Global Macro at Amundi Investment Institute, and formerly Deputy Director at the IMF's European Department, where we got to know each other in your previous life. Then, next to my right, Elke König, former Chair of the Single Resolution Board. Elke, before that, you had an impressive career in the financial sector and as President of BaFin. Lucio Penck, a non-resident fellow at Bruegel, and formerly Director for Macroeconomic Policies at the European Commission. In fact, we know each other from 30 years ago. And Rolf Strauch, Chief Economist and Management Board Member of the European Stability Mechanism. Now, without further ado, let me turn to Mahmoud and ask a few questions. Let's see which of them you can answer. I hope for the best. So, for instance, where do you see shortfalls in the current EU institutional framework? What are challenges from the US withdrawal from the OECD corporate tax agreements, which is one aspect which is not so much discussed in the public, but which is of vital importance also for the fiscal revenue capability of the EU member countries? And regarding the international financial system, this was really covered a little bit in Marcus's keynote speech. How might the EU react to some sort of a US Mar-a-Lago accord? So, Mahmoud, without further ado, over to you.
Thank you, thank you. And thank you to the organizers, as you thanked, for inviting me. It's always a pleasure to be here. A lot of familiar faces, and one advantage of me speaking here is I don't have to go into too many details on Europe, which I often do elsewhere. So I can be quite brief. So let me start with the first of your three questions. I hope things have changed or are changing at a slightly more rapid pace. We heard earlier today on some of the initiatives. But where the institutional framework is still wanting, I'd make 3 points. One is, and I can expand on each of these, I do not detect a fundamental change in the relation between the EU and the member states. It's a source of a lot of, let me call it, a lack of progress. You see lots of very good initiatives, ideas pushed forward by the Commission, the EU, and some level of political agreement, but not enough action on the ground at member state level. This is an institutional feature. It's not necessarily a shortfall. It's a feature of the EU, which is that member states have to deliver. The EU doesn't have the capacity to actually go and enforce and deliver. So this can be in the area of capital markets union, which Elke will expand on. This can be in the area of macro stabilization, fiscal capacity. This can be in the area of coming up with a safe asset, which some would argue would be an asset, it would be a positive for the EU. All of those things are held up not at the EU level, They're held up at the member state level or lack of consensus or agreement at the member state. This I do not detect has changed sufficiently. Maybe there is progress. One can expect in the current environment slightly more rapid progress, but it hasn't changed. And for those of you who, I know you've discussed it earlier this morning, the bits of the banking union that are still not complete, they're not held up by the EU. They're held up at the member state level. And part of it is very critical, completing the banking union for the current initiative, which is the SIU, or the Capital Market Union. The second is a more fundamental, which is, again, I'm going to mention it without making it like something that I expect sort of imminent change, which is the EU's structure, the difference between treaty and intergovernmental. It occasionally comes up. It's the way the EU or the Eurozone has found it necessary to make progress. Otherwise, things would be held up. But there are areas where it is still a drawback, and it's what you would call a shortfall. The intergovernmental framework is not suited for some issues. And one can go back to things like how much is in the Maastricht Treaty about the debt limits and so on. Lucia will talk about that. Those are things that are very live now, and they will come up against this constraint. What I mean by very live is there is a strong recognition, which I think is warranted, that debt limits may not be, and it's been around for a while, debt limits may not be, the ideal may not be 60. And de facto it's been recognized, okay? We live with higher than 60. But this is an area where the residual doubt about what's in the treaty, what requires change, could be problematic. It's the rationale for fiscal rules. So, I think the one area which I'm going to be slightly speculative is EU governance, I think, will be impacted as the EU expands. Okay? If I was to speculate, let's say we come to the time when Ukraine joins the EU, whenever that is. Okay? I think the issue about EU governance will be very material then. It will be material because Ukraine happens to be a large country. It may not be such an issue for small countries joining the EU as the EU expands. And the two issues that strike me that are important when it comes to expanding, let's say with Ukraine joining, one is the perennial issue about EU budgets, who's going to contribute, okay? And the other is whether majority voting survives or unanimity and so on. Now those may be very fundamental challenges when you entertain a new member. Let me turn to you, I know I don't want to run out of time. Your second question on the US corporate tax. Now, let me emphasize, I think that's important, but it's obviously part of a broader agenda of the US withdrawing from various other things. Okay? I wanted to focus on this climate, etc., what the implications for ESG type investing, and then currently, you know, the big elephant in the room, which is globalization, trade, tariffs, etc. But focusing on corporate tax, I think it took a very long time for the OECD to find consensus and agreement on a uniform corporate tax standard across the advanced economy, the OECD bloc. When the US withdraws, I don't know, but I think there's a risk that this agreement may not survive, point one, okay? Because the US is a very large player. And the US currently, in its policy stance, is doing things which will undermine the corporate tax base for other countries. And let's just focus on Europe for now, okay? The whole drive for tariffs to bring more production, encourage companies to be located in the US to take advantage of the incentives of taxes and so on, no tariffs, etc., will undermine the corporate tax base in Europe. And I think that's a serious issue for everything fiscal that the EU thinks about. as I say, I think there's a risk that the agreement may not survive, which makes it even more complicated. It's not just the US you're competing with, it's the rest of the OECD. Okay? On your final question on the Mar-a-Lago Accord, if you start with the premise that this current administration is very, very keen on two aspects, which is it wants to bring the U.S. administration wants to bring the trade deficit down, and it wants a lower dollar. Okay, so that's the kind of framework that a lot of things are being discussed. Okay. We started with a possible discussion: is could you replicate a Plaza Accord, which seemed sensible because the Plaza Accord, a lot of us think it didn't actually work in the end. If you tried that again, it wouldn't work for many reasons. But at least it signified one thing, that during the Plaza Accord, there was international cooperation, okay? The Plaza Accord didn't work in the end, in my view, for Japan, which agreed to appreciate its currency, and the Plaza Accord only worked if you have coordination on countries willing to change their macro policy mix, which I find very difficult in this environment to get that kind of agreement. But in the US, we are currently being entertained with something different, something more radical, which is the Mar-a-Lago, or the ideas under the Mar-a-Lago Accord. Okay? What are the things that scare me about the Mar-a-Lago Accord? One is the idea of a lower dollar, lower trade deficits. Many people, including myself, would recognize that the current package, the policy package we see in the US is not going to achieve that. Okay? It's not going to get you tax revenue and a lower dollar and all of that stuff. There's a lot of issues there that I don't want to go into. I'm sure you covered them before. But some of the ideas in the Mar-a-Lago Accord, for example, let's start with something quite basic, which is an incentive offered to holders of US assets, US treasuries. And let's start with the reserve holders, like large central banks, or offering them some incentive to change their current holdings to longer-term debt. Okay? So this is a basic framework. You then go into some more radical ideas. Could you force them, or could you incentivize them by offering them trade agreements? The second, stretching it even further, is could you force a debt swap? Okay. Could you give them very long-term, 50, 100-year claims at lower coupons and so on? Because the idea is sold as the US is offering you something, is offering you a safe haven. I know some of you will laugh, but it's a safe haven for your assets, and in return, you should be willing to do it. There are serious problems with this because you're distorting the largest fixed income market in the world. What are the serious problems? One is, I think it's disingenuous to talk about just large reserve holders. We could say China is a large holder, etc. Once you distort a market, you affect everyone holding that asset, okay? If I was to just look at European holdings of US fixed income, and I just added official holdings plus private sector holdings, that amount is bigger than what China is holding, okay? So it's not just a discussion about can you persuade China to be attracted by some incentives, okay? That's point one. You're going to affect the marginal buyer. Secondly, on the same point, there is a talk of could you force a debt swap? Now, if you ever went down that route, I think you would be looking at a rating agencies classifying that as a technical default. Okay? Now, I can't be certain about that, but if you force someone to change their asset, that's a technical default, right? Imagine a technical default in an asset which is forms the largest amount of collateral in various markets around the world. Most of the derivative exchanges, US Treasuries, are a very large part of collateral. Imagine what happens if you then, each of those exchanges requires you to change your collateral for an asset that's not under default, or you get margin calls. These are really, I mean, they're tail risk events. So I'm not saying this is not currently but these are issues that are talked about. Okay. Nicholas earlier mentioned the Stephen Moran paper. I mean, these are the issues that I want to say, look, these are not, I agree with Nicholas, I'm not saying these are administration policies, etc. But these are tail risk events that are sometimes, the point I'm trying to make is, are talked about just in terms of saying, look, let's think about, would China be willing to do this or willing to hold an asset in return for some tariff negotiations? These have much wider repercussions than just China, okay? And the Europe example I give is to say this would affect a lot of people in Europe, right? I mean, a lot of private savings in Europe, assets are held in US treasuries, as in other parts of the world. Ernst, let me stop there before I take too much time. I'm sure there may be questions.
Thank you very much. Let me now turn to Elke. How should we actually meet Europe's huge financing needs in the EU for various big projects, from capital market union to savings union and investment union? Are the special Sondervermögen, or whatever the English word is, and Stability and Growth Pact exemptions the solution? Or should we rather look at private financing sources to directly finance financing needs? How about EU and national backstop solutions? Institutions, are they fit for purpose in the new environment? What are the limitations? What's the scope for further action in this area? What to make of the slow progress with Capital Markets Union and Savings and Investment Union? We exchanged an article which I read recently in some Austrian newspapers. So even to the small country of Austria, the lack of progress there and the lack of agreement on this, I would say, relatively uncontroversial issue, you should believe, cannot be found. What's your take on that?
First of all, let me thank the organizers for inviting me. It forced me to really take a very detailed look into Savings and Investment Union, where otherwise I might have thought we had the Capital Markets Union. Let me wait till some of this is materializing. That's then early enough to take care of it, which should not be the first answer to you. I think building on what we've listened to in the previous panels, but also building on the arguments within the Letta report, within the Draghi report, and some of this is just common sense. I think it's very obvious that we need to mobilize capital in Europe to fund the transition, to fund defense. So to that extent, I think we will all nod, we are all in agreement. Then it comes to how do we have to do it. I think it's very obvious that the answer is CMU, or as I assume the Commission has rephrased it because CMU got a bit the feeling of it's an old hat. So now it's called Savings Investment Union. It started, looking back, in 2014 when it was still Jonathan Hill. And he was talking about it when we had, in principle, a capital market. It was called London. Now, this was pre-Brexit. Since then, we are dancing around the topic. We had a revival in 2020, but we have not really made big progress. It's different when it goes to the banking union, but it's also different because the banking union, we made substantial progress after a near-death experience, after the great financial crisis. And who wants to read the history, I would recommend Nicolas Véron's little booklet on the development. The banking union, first step, single supervisory mechanism. First, nearly complete step, single resolution mechanism, was the result of everyone was scared to death. And it seems to me that we have not yet reached, and I would dearly hope that the recent weeks or even days are the wake-up call for us to realize that we also need to work on capital markets. we are in a situation where we have 27 capital markets, which means nicely fragmented. No one has really critical mass in this market. This as a first. Now, let's assume, how should we look at it? And looking now at the latest proposal from March on the CIU, I think there is one point, to be cynical first. There are 25 bullet points. For me, if someone comes up with a list of 25 things we have to do, I know the only thing is I don't need to take care of this for the moment, because let the 24 others be dealt with first, and then I might come afterwards. So I fear a bit that we are once more falling into the trap of having by far too many points in, or by far too little focus. And just to use one phrase out of it, it says in focus, it's all of the EU financial system and to be developed at both EU and national level. Totally true, but also scary, because it means let the others go first, at least for me. But I think there is one very big pro in, and it's the SIU is really focusing on mobilizing equity. It's not focusing on debt, at least in my reading. It's really how to mobilize equity. That's a clear plus. And it might actually need a far broader thinking. We were talking about it during the lunch break. There is something called tax law, which is national. And a lot of tax law is in the way of people investing cross-border. It's just cumbersome, and you pay double taxes. So withholding tax to be regained and the like. So for me, when looking now at the different buckets of the Savings Investment Union, I think the first two chapters, or the first area, which is on mobilizing private savings, is perfectly right. The analysis is fantastic. The unfortunate part is that's a long shot. We have the, how's it called, pension products. It's an absolutely intelligent idea, but first you need a pension system for this to really gain. Now, one argument, and I think this is an argument for countries, is we have pension funds in the Netherlands. We have private pension savings in Sweden. Now, the Swedish are not known to be the, now I use a German wording, zockers of the world. They are not the most risk takers, most likely. But we don't have this in Germany because people rely on their state pension plus perhaps a company pension. So I think we need to probably, before talking about improving the pension product, we need to talk about improving or making people understand the pension system and making this move. I hope for the new German government, there's always hope, that they are addressing it to some extent, but I'm not sure they will. So this, for me, is clearly more on the long run, where I think we hopefully will make progress during this term is on promoting investments in equity and certain alternative asset classes for institutional investors. For me, this looks like the lower-hanging fruit, including starting with securitizations. I don't envy Sean that he has to deliver his brilliant proposal within the next 2.5 months during second quarter. But I would really ask, and it's going a bit back to the discussion we had before, that we look into aligning capital requirements, but also, far more important, it's not about deregulation, it's about simplification. Why can't we try to achieve more standardization and then use actually a far more streamlined process for supervision and for information provision for securitizations? They were a bit of four-letter word after the great financial crisis, but I think we have, with all good intent, a bit killed the project to some extent. So streamlining there, trying to find out. And one argument from my side for people like me that then need to read all these documents is, and please align between a commission coming out with a proposal, a joint committee of ESAs coming up, the ECB coming up, well, the poor guys that need to read all of this and try to make sense out of it. I would say start with an idea, clean up the system would be just. It's easy to say for me now. Private equity, venture capital, I think there the paper addresses all problem areas. But unless we create a European framework, this will always stay fragmented. It's on tax law, it's on insolvency law, it's on restructuring, right? Now, I would always say if I want to invest, insolvency law should not be the first area to be nervous about, because then I should rather not invest. But you need at least to have an exit strategy and the like. So there, the suitable exit options, it's all mentioned in this paper, need to be addressed, and I wish the Commission really luck to go for this. I have to confess that I realized that some topics were entirely new to me. Faster, which was on the tech side, never heard of. EuVECA, I had heard of, but honestly, I didn't really know what it was about. So we have a lot of beautiful projects in Brussels which probably need to filter through. The area where I think we need to make really progress, and it's from an economic perspective quite easy to say, why on earth does the US have basically two trading places, New York and Chicago? Europe has, well, 27 plus. We have even in Germany more than one exchange. You don't know for what, but it's very nice to have more than one choice. So I think we need to overcome the entire fragmentation of this market, and I think this is probably an area where we don't need to convince Brussels, we don't need to convince economists, but for whatever reason, countries believe that it's part of their autonomy to have their own stock exchange, to have their own CCP, and now looking at Sean, and I think we made the wrong turn, or took the wrong turn, when we worked on CCP resolution. There are not so many CCPs. Why on earth couldn't we at least at that point make sure CCPs go under European supervision and resolution authority? Instead, we budged it around. We need scale. Regulation and supervision should be European only. And I would even go one step further. I don't see any logic why this should not be bunched together with banking supervision and bank resolution. Most of them anyhow have a bank license, which means it goes to some extent. I know that the ECB didn't want it, but anyhow, I would plea for it. And we should think in this context also the role of the ESAs, and shouldn't blur the lines between regulatory support and supervision. You can't be both. You can't be the one who writes the regulation and then is the one supervising. And let me to come a bit to a conclusion. We should finalize the banking union, but also on the banking union side, and it's going a bit to your argument, national versus European. The banking union was a success, is a success story. But when I'm looking at the standstill over the last minimum 2 to 3 years, I wonder how to move forward. There was a CMDI proposal, fairly complicated. It left the council with even more national pieces in, so that someone like me, who was in the beginning very much in favor, would say, as of today, forget about it, do a fresh start at a later point. Because if you renationalize resolution power, well then, you have not learned the lesson from the financial crisis. So this would be, and on the EDIS, I don't think, it probably needs a new name, like CMU, but we need at some point to get it done. And therefore, my priorities, and I've not answered all your questions then, is simplify securitization. Should not be rocket science, but don't make it too many people drafting it. Improve the private equity venture capital framework for institutional investors. Try to look, I find this a very charming idea, for how to basically draft private co-investments with EIB or the national promotional banks. That could be an argument to look into. And push for a truly European capital market infrastructure that hopefully, as a second step, will lead to concentration, though formally the banking union has not led to concentration either. And stay focused to overcome the incredibly costly fragmentation of our European markets. Quite an easy task for Sean for his last month.
Thank you very much, Elke. Yeah, I think there were already quite a few institutional suggestions in here, both for the public side, the regulatory supervisory side, but also for the private sector side. So a lot of food for thought. Thank you very much. You also raised already the issue of backstop, and that leads me over to the issue of public finances.
Yes.
And with this, I turn to Lucio. So is persistently high public debt a problem for us in the US, in the EU? How do you view recent developments in the EU fiscal framework? Is that all so super and so fine as we often hear? Or there are also risks involved with this development? And how to assess the escape clause in the Stability and Growth Pact, the new loan instrument to finance rearmament, and the overhaul of Germany's debt brake? With this, I hand over to you.
Thank you. I've prepared a small presentation. Now I have to do these things myself. We were discussing, so bear with me if it's not so snazzy as those colleagues who have still have staff working for them. So I start with just a bird's-eye view on the evolution of debt. It comes from a paper that colleagues from Bruegel are due to publish soon. Let's focus on the EU, which is enough, I would say, for the purpose. So that is at very high level. Now, can you discern a clear trend? Well, it depends. Probably, actually, you should. If you had also the 80s, you would see a more clearly upward trend. And when I teach my students about these matters, I tell them you have to look very long trend because if you look just a few years, even 20 years may not be enough. The drivers of that, however, from what we heard about population, productivity, social entitlement, interest rate is a bit more of a question mark, perhaps. In general, they are not moving in the right direction. But two things focus in the European Union. You see, there is a very high degree of dispersion. I mean, the band there describes the distance between the 25th and the 70th percentile, so that we know. And then the other thing is that sustainability is a directional concept, essentially. So it's not so much the level where it's headed. So what can we say? Bearing in mind, I think also we know it, but Sean reminded us, I mean, we don't have a fiscal union, so it's a nice thing to have the median debt of the European Union, but this is not really what matters. So here, and this is the only relatively technical slide that I have, it comes from a study that will be published soon by a colleague in Bruegel. The study deals with how to assess sustainability in a broader sense. Here I just pick up one of the results, not the most important of the study, but the most important from what I want to say. So, how different countries are added. And here is an exercise, the base of which are the WEO autumn projection. Now, the WO, I had discussion with colleagues from the fund, is not, unlike the projection of the Commission, which are supposed to be unchanged policy, the WO, but okay, we have also formal stuff, is supposed to reflect the central expectation that the staff forms of the policy of a country. So what is going to happen? Yeah. We in the Commission, we defend ourselves. Well, it looks like this, but this is unchanged policy. Of course, next year or 2 years from now, there will be adjustment that will take place. So based on this, the colleagues have done a work. They built a fund chart. I will not go into the technical detail to stabilize the probability that in 5 years, in 2029, the structural primary balance reaches a level that would allow stabilization of the debt over the following 20 years with a 50 or a 70% probability. And here you see, I will not go through all the countries, but you see two things. Well, I mentioned a positive first, especially because we are at the ESM. You see, Greece and Portugal are doing quite fine. So we can be reasonably confident, based on our central, or rather the IMF staff, central expectation of what is going to happen, that they should be able to stabilize their debt, or at least they have 61% for the 50% probability. So, but it looks very bad, and here I was reminded, I think Jon spoke, being worried about Italy, in particular there, you see the percentages are extremely low, 0% actually on the 70 probability. Also for Spain, France doesn't look much better, Spain only marginally so. I don't discuss the country down there. You may look that the Germany may not look so good. I put that in pink instead of red, but you may say, okay, and we discuss afterwards. I mean, Germany still has a comfortable level of debt. So things do not look so good, although nobody knows what are the debt limits in terms of a stochastic assessment of the probability of stabilizing the debt. Now, we have a set of fiscal rules, you mentioned it, and here it's, I could spend many hours on this because I was involved in a good part of the story, but don't be worried, I will not. I'll just focus on the last part of the story, and you see there are two arrows there, one between 20 and 24. Basically, this was the pandemic crisis followed by the war in Ukraine and energy crisis. Essentially, there was a suspension of the rules. Then in 24, we had the reform, which was actually the last file on which I was personally involved. And then 1 year later, so barely the ink is dry on the new set of rules, we have recourse to escape clause that you evoke. What does this mean? Well, here I have a question, a bit a provocatory question. If you are interested more in the argument, I have to make some publicity, not so much for me, but for Bruegel. I just published a longer paper on this about fiscal escape clause. Now, the Commission has framed it, I would say, in the best possible way. So basically insisting that the deviation that this escape clause would allow would be limited in scope, time, and size. And I think in doing so, they were mindful of the experience with the activation of the so-called general escape clause in the past crisis that effectively was a free-for-all, resulting in some bad fiscal outcome. I don't want to criticize across the board, but clearly there was this, my colleagues, and I still talk with them, were mindful of this. So basically, the idea is to provide maximum flexibility, but still within the framework of the rule. However, I think we need to make a distinction, and here I borrow from a suggestion from a colleague, between a legal and an economic notion of fiscal space. Because after all, when you change or you allow exception to the rule, you are looking at the legal framework. Now, the thing is, the low debt member state here, I use the technical version, above 60%. Actually, if one looks at the fine print of the rule, they did not need at all this escape clause, although we advertise it urbi et orbi, because according to the provision of the pact as reform, they already could increase expenditure, even breach the 3%. Some provisions were acted for in relation to military expenditure. So the escape clause is actually, although it's not said publicly, aimed at member states with higher debt. But this debt, I mean, those at least on the top of my of the list that I was showing before, may not have the extra economic fiscal space, because even with the recourse of the escape clause, may have suffered negative market reaction. So they would like borrowing. And here I should add, and this links to what we heard in the keynote of this morning, that they may not also like running the fiscal risk for a kind of expenditure that doesn't pay big political dividend. I mean, we heard, I mean, of course, if you are a frontline country, things look different, but from the perspective of Italy, and I think we heard the confirmation today, it doesn't look really a very promising, electorally promising way of spending public money and incurring public debt. So I come here to the conclusion that the escape clause could make a difference, really, although clearly we will not be saying that in our communication, speak still as Commission, in a sense, as a signal that they will be protected by the TPI umbrella, something should happen. I mean, I know this is rather controversial. We should remember that the condition, first and foremost, the condition of eligibility for the TPI is compliance with the fiscal rule. Essentially, the escape clause could be read as if for the next 4 years, the Commission, I am, of course, now I can speak a bit more freely, this is not what is officially said, the Commission will not declare any country not compliant with fiscal rule, or let's say, is highly unlikely, let's put it this way. Of course, we know that the ECB remain in the driving seat when it comes to that, but you may ask yourself, I mean, should something happen, the pressure may be strong, so in this sense, you could read the escape clause as a signal. Now, perhaps for the sake of time, I will not go to the EU borrowing. I don't know if you want me to cover. The thing, let's put this way, the only thing that I want to say, I mean, when people think of EU borrowing, there are basically two possible models after the COVID crisis. One is the RRF and the other is SURE. I mean, the big difference was that the RRF involved grants, and this is what the likes of Italy or Spain, I think the Spanish Prime Minister said it rather openly, would have liked. This has not come to pass. What we have is what is called SAFE, is called a defense SURE. So basically, it's back-to-back loan to member states. And we have to see how much demand will be this. We know that the escape clause is meant to allow recourse, including by breaching the 3% without penalties from the point of view of fiscal rule. But still, the bulk of the defense investment that is envisaged is to be occurring at national level. So finance decided and executed at national level with all the implication that this may have. You may see also as a form of industrial policy, let be blunt. So now I think is my last point, how I see the reform of the German debt brake. Well, actually, it was a bit, in terms of public relations exercise, I think the Commission President may not be too happy that her announcement of unleashing 650 billion, actually of national money, coincided with, was a bit overshadowed, if I may say so, by the announcement of the agreement of the reform, the big overhaul of the German debt brake. So what do I think of that? I think you can see it from 2 points. From the single country perspective, and here I'm not discussing the macroeconomics of this, maybe Mahmoud is better placed nowadays than me to do that. I'm just looking from the optics of fiscal architecture. So I have to say, if I look from a single country perspective, well, I think the easiest way to characterize the debt brake is a sort of a defense golden rule. I mean, I will not go into the detail, but I think the classification stands. And actually, then let me blunt, usually I'm no fan of golden rule. Actually, most of the people in the business are not. I mean, this is my reading of the literature. one may add that a defense golden rule has further counter-indication. It doesn't make a distinction between current and capital expenditure, for one thing. Then the effect on the productive potential, which is one of the usual justification of the golden rule, are not there, or they are very limited. So quite frankly, political economy provides the only rationale for this. And this actually, we heard it in the keynote this morning when we were reminded that the previous German coalition collapsed on this because on the conflict of, say, between, say, higher social expenditure, or the need to cut social expenditure if we wanted, say, to increase defense expenditure. Now you allow the recourse to debt. But also economic theory teaches that if something is permanent, not temporary, then it should be tax smoothing, basically say you should raise your permanent revenue, cut expenditure otherwhere, not recourse to debt. At least on a temporary basis could make sense. So not very. Now, from the EU point of view, however, we should not get into this matter because the EU perspective is not to prescribe the right fiscal policy to country, but essentially to avoid unsustainable debt trajectories. And here I have just, and here I conclude with a question mark. If we look at the German situation, well, I think my current director, Ron Zettelmeier, has written a paper explaining why, all in all, the debt brake does not put a problem with debt sustainability. There is, assuming that defense expenditure stays within bound, it stands to reason that then that will converge to a finite level, and also the calculation for plausible value gives a value of debt that are not too worrying. So, but I do see a problem in a EU dimension, because it's difficult to reconcile the reform of the debt brake with the rule of the SGP. Mind you, I say here non-temporary implementation, but the debt brake is a change in the Constitution, so it's supposed to be something permanent. Now, right now, I suppose, as I write in my paper, right now the Commission and the Council will be spared the embarrassment, through the recourse of the escape clause, will be spared the embarrassment of passing an immediate judgment of the reform. They say, with what Germany plans to do, it's fine. But long-term wise, there is a conflict between the rule of the SGP, assuming that at least, a colleague told me, but you know, Germans have a habit of creating an envelope which then they don't use. So, well, if this happens, maybe. But the way it's written, it looks like to be used, and then as such is in contrast with the rule of the SGP. And here I don't want to sound too worried, but I think that makes the fact that Germany is challenging effectively the rule that were reformed, including restrictions that I consider economically irrational, that were included at the demand of the German government less than 1 year ago, and now is openly challenging, I think creates a problem in the perspective, say, of the possible calls on the ECB to intervene to protect countries with less fiscal space. At the very least, I see it an additional complication. So I conclude, some people have reached the conclusion that the fiscal rules are dead. Well, for biographical reason, I cannot reach this conclusion. So I think one could accommodate, if there is the political will, a reform maintaining the focus on sustainability, which was the main characteristic of the reform. One could think of a reform, although I understand it's not the thing on the, it's a bit on the back burner now, but I think we have to go back. We go back to the old dichotomy for monetary union. You see it from the paper by Lanfalussy at the time of the Delors report, whether market discipline is enough or whether you have to recourse rule. I think a framework is still needed. I'm a bit worried about the stability of the framework going forward. Thank you.
Thank you very much, Lucio, also for the strict voice regarding Germany, setting a bad example for the rest of the EU.
For the second time.
Yeah, for the second. I remember well, absolutely. And now I think it is time to show the strength of the EU framework now by giving the word to Rolf. Rolf, in your view, what is the EU's value added for member countries' big current challenges of climate change, geoeconomic fragmentation, defense? How to divide the responsibilities between the EU and national levels? What are key strategic elements for the European policy agenda? In terms of lending capacity of EU institutions, what orders of magnitude are we actually talking about? How much powder do we still have dry? Do we need more powder? Over to you.
We have, can you hear me? Does it work?
Yeah, we can.
We have big task ahead of us, so we certainly need a lot of powder. But before I go there, let me put briefly this issue also of European national cooperation or interaction into perspective, and refer to what I think is kind of the fundamental system of how the EU works. And there are basically the three pillars that I put up here. The one is the single market, which is the very basis of the EU. Then there is the element of solidarity, and some people wonder whether this still exists, but after all, the ESM is a mechanism of solidarity. You think about Next Generation EU, it's a mechanism of solidarity. Pooling resources at the EU eventually is a mechanism of solidarity because it's all in one form or another about some form of transfer or benefit distribution. And then there is importantly subsidiarity, and I think it's not probably not a coincidence that also Markus made that point about subsidiarity. It's a very German thought, but it's very important because we cannot understand what's going on in the EU without also taking that serious. So the fact that national governments can do and should do what is possible and what is in their capacity, what reflects actually also the preferences of their constituency. And when it makes sense, then you delegate up. Then you start pooling, then you create common responsibilities in order to be more efficient and deliver what you cannot do at the national level. I think that's our core principles that have been carried through and that can actually help also going forward. I think also what it does is when you think from that perspective, you very clearly think, when you think about the agenda that we have been spending in this conference, it's clear it's not only a EU agenda, it's not only a national agenda. It has to work on both levels. And I mean, if I take the topic of savings and investment union, there was this controversy between bottom-up and top-down. I think what is becoming clear also with the paper that was put forward, you need both levels to work because we will not have a bigger, deeper capital market without doing the necessary pension reforms. Pension reforms are a fundamental national authority and politically need to be also nationally fully backed. So that is a point where then the national dimension is important in all those key themes that we had: climate change, geoeconomic fragmentation, and defense readiness. But obviously that's not enough. You need to have the European dimension also there where it is clear responsibility, and we pointed to that when it comes to trade, when it comes to questions of regulation. But and that I think is important when with the agenda that we have been spending now, is the point that when I look at the agenda that came up for EU responsibilities after the great financial crisis, the sovereign debt crisis, this was more about pooling and regulation. If I look at the current agenda, I think it's more about coordination and also more about the creation of a market, where that comes into play here. And I make the point about coordination. I think that is for me the key innovation of the Draghi report. When you say industrial policies, we want to have an EU industrial policy. Many elements of that are indeed, again, national. But if you want to have a common response, we need to coordinate on that. So that is an additional political dimension that comes into play here. The second point is, what I think is an innovation here, is the combination of creating a single market and providing necessary financing. You see that, for example, in the energy market. We want to have an energy market, which means we need to improve on that, but we also need to have the necessary resources to get the infrastructure going. So I think there are new fields of interaction between different policies here that we haven't had before, which in the future will shape what we do nationally, in coordination, how this is supported at the European level. Okay. And in that regard, there are key elements that I see for the EU strategy and the EU policy agenda forward going. One is clearly build the post-2026 financial architecture, And that means rethink the EU budget. What do we want to do with the EU budget? How is the next MFF, should it look like? What do we actually finance through that? And there's the question, do we need to do much more for technological innovation? Get something out of the old pots of money and redirect it? Question, should some of that money go into defense? So those questions have to be addressed. The EIB, ESM also need to be in the picture. Because I think one of the key elements about this European infrastructure is also a certain division of labor that has developed over time. Where you have an EU budget with a number of tasks, you have the ESM that has a stabilizing mandate, looking for financial stability, and you have the EIB that has very different tools of leveraging, interacting with the private sector, and can make use of those tools. And in doing so can do exactly what I said before, helping creating a market. For example, if you think about defense, EIB has now moved into that sector in order to be able to finance defense projects, defense-related projects. If you want to create a European market, we have the proposal of the European Commission in kind of having joint procurement, then that is a financial resource that can be leveraged in that regard. So there is an interaction combination of measures that is emerging here that wasn't there before, and that we will need in order to create new avenues. Second point here is advanced market integration, and that's very clear. We talked about it before, and we have talked about it in much detail, where there is the points on energy, transport, financing, which are the key dominant areas on which we need to act. And finally, there is this established European strategy on defense and competition with the elements that are European and that have to be done at the national level. Here the question is, what can be done now and what can we do in the future? The 150 billion are now mentioned. That's probably not enough. We know that Draghi talks of 800 billion, what we need. And for me here the point is only, yes, we need to have a long-term strategy. We need to have a long-term strategy to how we want to allocate also the MFF, but getting there still takes quite some time. So the question is, what is the resources that we have currently available and that in one form or another we can actually use or about which we can think. And if you look at the common currently available European resources, obviously there is the fact that you have the balance of payment facility, that's 50 billion that is not used. You have still quite some amounts in the recovery and resilience facility that has not been disbursed so far. So this is about, on the grant side, it's about 160 billion, and on the loan side, 180 billion that is still available. This is very temporary, but at least for the time being, and that it's there, you should try to make as good use of it as you can and eventually use it potentially as a bridge towards a longer financing arrangement. And then finally, there's obviously the ESM. And on our balance sheet, we have a lending capacity of 500 billion, of which at this stage, almost 430 are available lending capacity. We have a mandate, but there is a point obviously also to think, and that is what we are doing, to think about how that capacity can actually be used effectively and efficiently for the challenges of the future, which are related to geoeconomics, climate change. And in that regard, we have done a toolkit review, and that will also be discussed forward-looking in the Eurogroup. And the question is, well, the ESM is a child of the past crisis. Is the toolbox that we have with precautionary credit lines and so on fit also to address future crises and how it would have to be adjusted potentially in order to be efficient? So that is how I would look at the situation, which has created new challenges, but therefore requires also new policy recipes, a new articulation of instruments across levels in the cooperation of market creation and market financing. In order to get there, we should use efficiently what we have currently available.
Thank you very much, Rolf. I think this is quite encouraging, but it's clear that we have huge financing needs. And the immediate question that arises, how much is the market willing to absorb? So there is the example of Germany, just so far just an announcement, but usually financial markets react with announcements, announcement effects. And also, if we stock up on EU funding, what would be possible implications? Would the markets take that? What might be implications for ratings and so on? So maybe I turn first to Mahmoud on these questions.
Okay. Thanks. And I'll start off with a couple of observations. And Lucia, you made a very good point. The market reacted very strongly to the German announcement. The market did not react to the Commission announcement on the fiscal escape clause or the 650 billion for good reason, because that is member state level, and you have to wait and see whether member states utilize that extra space, more borrowing. I think we're at a dichotomy. Germany clearly, as Lucia says, Germany has fiscal space. The market is anticipating more issuance over time and has repriced German debt accordingly. Okay, that's all kind of normal. The question marks now arise that German debt, higher bond yields have already reduced fiscal space for the rest of Europe before you even get to the fiscal escape clause and what the 650 billion, okay? So one can, and a lot of us in the markets do some numbers. I won't go into the numbers, but fiscal space in France is already reduced. French bond yields are higher. Italian bond yields are higher, et cetera, et cetera. It is very misleading for this discussion, not for market discussions, for this discussion, it's very misleading to focus on spreads. Right? The spread between Germany and France. That has stayed stable and is a function of various things going on in France, etc. It's the absolute borrowing cost that countries face that matters for all our kind of debt sustainability, fiscal space, etc. I think that's a really important point to remember. It's no great insight. The absolute borrowing costs are already higher. So this will affect what Lucia was talking about, how countries look at this in their own fiscal space and their own decisions about whether to use these escape clauses and for the priorities that are currently the challenges, defense, for example. Secondly, I just want to make a point in passing, and I'm not going to dwell on this very much. It's the NGEU. One of the disappointing things about the NGEU, which everyone welcomed, and I was part of that in my previous role. When you look now, take stock, is it appears that the NGEU hasn't changed potential growth. With the Rolf, hold your fire. At least in most countries. Maybe it's too early to tell, maybe these reforms take time and so on. But I want to come back to the market question. The market, there are some positives here. The market is very easily will absorb German debt. I'd go even further. I'd say the market, and especially for global investors, it's encouraging to see a European safe asset as a viable investment vehicle, German debt. We've come through an era where US treasuries dominated, etc. I think that's very positive. So the market will be able to absorb it. It's how the other countries deal with the fiscal space. But the one thing to bear in mind, and I'm going to go through a very small illustration, is global bond yields at the long end are very, very highly correlated. And I'll give you one example. After the election result in the US bond yields went up quite sharply, 10-year yields. And the reason was a sort of different outlook expectation, more optimism, but it came also with higher expected inflation, and the Fed had to change, et cetera, et cetera. Net result, you end up with higher US bond yields. That had a very strong impact on German bond yields, even before the debt break, whatever, and a very strong impact on the UK. When nothing had changed in Germany, nothing had changed in the UK about expected inflation, that's a reality we're going to have to live with. So I want to leave you with one thought. The US fiscal outlook has not changed at all. If you look at Congressional Budget Office expectations, etc., debt is still going to be on a sort of upward path. We're at 35, 36. Within 10 years, we're going to be closer to 40 trillion of outstanding. That's something to bear in mind for the long term. This is, it's not something that we can ignore. It's in my view, it's still the kind of big global risk, but it's not for today. By the way, for a short period, when the German bond yields went up, when the debt breaker, the change was announced, for a day or two, it also went into reverse. It affected US long-end yields as well. So these correlations matter, and this global risk that I'm talking about, the US fiscal outlook, I don't think is going away. Okay, so that's the kind of answer to your market question.
Thank you, Mahmoud.
Sorry, you want Rolf? Rolf has a two-handed.
No.
I know he's not putting them up.
Immediately, just a second. So I think your last observation is actually quite consistent with macroeconomic theory. I've been looking at global interest rates a little over the past couple of weeks, and in the end, it's the global savings investment balance that should affect real interest rates at a global level. Of course, there are frictions and so on, but this is what you are seeing. We also know that it's a little bit asymmetric or quite asymmetric, that US rates affect euro rates more than the other way, but it's actually not surprising that it works in both directions. Now, Rolf, you wanted to come in on the impact of NGEU on potential output.
I think 3 points here. First is what I think is important also to note: when the yields went up because of the German announcement, they did not go up as a reflection of additional credit risk, right? So but that was basically in markets was higher growth expectations. In the short run and in the longer run, after all, it's also packaged on investment. So I think it was not a reflection of credit risk per se. So that and therefore the reading overall was positive.
I agree.
This is good news, right?
No, sure,
it's not kind of so. Point number one. Point number two. Of course, on the potential output impact of Next Generation EU, it's super difficult to measure, and it's early stage. I mean, these are hundreds of action, and we will only, after a while, have the final balance and be able to say where it's effective or not effective. It's not to say that, obviously, we can expect a big boost in all countries. In some countries are also very small, but I would also say it's a bit early to say there was no impact. What we can probably say is, compared to other programs, US, IRA, one could have that effect potentially more efficiently and with less administration or maybe more agility. But I think it's still, for me at least, I would say the jury on the output or potential output effect is still out. Final point is, and I fully agree with you, that the fiscal situation is not an easy one. I mean, you have higher interest rates. Now, if you think about the impact of Trump means, and tariff means lower growth, which means that per se the fiscal space and the fiscal path as defined with the nominal expenditure growth is getting essentially tighter or may become less sustainable. So these are indeed factors that need to be taken into account. But my perception is also this is well clear. And it's clear that the national escape clauses are indeed temporary, and eventually these amounts have to be absorbed in the budget. And there should be no doubt about it, that that can only be a very temporary solution that eventually needs to be financed somewhere else in the budget. And the second point is, you need to better do it in maximizing the fiscal multiplier. I mean, you need to do it in a way that maximizes the growth impact of those defense spending. Otherwise, it won't add up.
Can I just add one point?
Of course.
Rolf, I don't disagree with anything you're saying. My only comment on potential was just, look, I look at Commission forecasts, IMF forecasts, or anyone else, right? No one has changed their potential for Italy. It's actually lower than it was pre-COVID. The only country that I see, and I may be wrong, I'm not looking in detail every country, there's changed potential growth is Spain. And the reason is not NGU, the reason is immigration. Okay? Spain is accepting more immigrants from Latin America and so on, right? And that's, I don't want to get into that issue. On the financing point, I do want to make the point here, which is that let's take, for example, SAFE or ESM lending or some kind of EU lending to member states, okay? Your final slide, right? I think we need to recognize that the cost of this lending is now very different, okay, than it would have been a few years ago. Okay? Yes, countries that are faced with higher market borrowing costs would have some benefit, but that benefit is not so large. Okay? It depends, say, compared to the QE era or something like that, right? I mean, you just have to look at ESM financing costs. Now, they have changed because the world is now in slightly higher interest rates, right? So ESM lending, for example, would be advantageous to some countries, but not all of them, because they have, you know, I'm just being just a factual observation. I think that's important to bear in mind when you look at the fiscal space. Now, I agree with all your points on multipliers, and that depends on what type of fiscal policy, and I guess that's policy advice, right? I'll stop there. Thanks.
I would just like to
course.
react a bit, and I might now sound like the typical, what was it called, Swabian housewife. We are talking
quite.
here, no, and I'm not Swabian, as you can hear. No, we have, I am concerned that, and reflecting what Marcus said yesterday, what Catherine said this morning, with the temporary easing of all our rules, with the debt break, with the Sondervermögen, which is a misnomer, it's a liability, we are basically escaping reform. It's easy to talk about, I need to do this, and I can keep my old social security system, I can pretend that all my pensions are safe and the like. And this is where I'm really concerned, that we need to address this. And for me, now to get back to my topic of capital market union and the need to free up private equity to fund growth. I'm not funding growth by just piling up debt. And I think you're right, when you look at all these discussions, it can be a temporary start, it can kick off, it can be a bridge, but it can't be a permanent solution. Sorry, I sound like the Swabian housewife, but
well,
they had normally some economic common sense.
I think you just created unwillingly the new term Sonderverschuldung instead of Sondervermögen.
Yeah.
Well, I mean, let me stay with you. I think you made quite important points on the lack of harmonization, lack of getting agreement for capital markets union, and an item that has been discussed a little bit is the so-called 28th regime. So what's your take on this? Could this be a solution? So if the member states cannot agree on joint rules, then you just make a 28th rule, which companies then might be happy to accept because it's at least unified.
Well, I think there was something before the discussion about the 28th regime, which was the Societas Européenne, which took a bit of traction, but it took very long to really move. And it actually, at least from what I've seen, it moved where companies used it to do cross-border merger a bit easier. When you now look at the broader 28th regime, well, if you still stick to entirely national corporate law, if you still stick to entirely national tax law, what does it mean? I choose one country and I build my regime on this, or am I still linked to the country where I'm located? Then I'm not really winning much traction. So when thinking about it, I got the feeling the 28th regime is a fantastic idea for Europe. It's a bit roughly the same idea as Esperanto was, but we've in the end all moved to English. And this, for me, would mean let's try to push for harmonizing and having just one European set, by the way, under regulation and not directives for the capital market rules, and move stepwise. Then we might even be able to live with different tax regimes, with different corporate law.
But let's remain a little bit with the Esperanto example.
Yes.
So it didn't work out. So what happened instead? One language, English, became the Esperanto.
Yeah.
So why does the same thing not happen on legal frameworks? Why don't companies just...
To be fair, it happens to some extent. When you look for issuing, well, if you issue a bond, you go for English law. And we had the laughing story at the SRB when the Brits unfortunately left the EU, and one of my colleagues said, we need to push the banks that they issue their bonds under European law. And I said, fantastic, let's take German law. That's the one I know best. And he said, no, I thought of French law. So I think to move...
ESM moved from English law to Luxembourg law.
Yeah, which makes perfect sense.
Which a lot of other issuers did as well, right?
Yeah, but I think this is what might happen, and which I hope will happen, that issuers move to one set of law, which then is understood by everyone. Mm-hmm. So Luxembourg could be the ideal model for bond issuances, but I would hope that we also move to having just one place, or at least maximum 2 places for capital markets over time. You can't force it, and the 28th regime doesn't get you there.
So that would be then some sort of market-led harmonization.
I think it's probably the most realistic one, by my take.
Well, it's interesting. We'll see. Let's see what happens in the next 5 to 10 years. Lucio, I want to now come back to the fiscal matter. A big issue that has been discussed at least since the GFC and the sovereign debt crisis is the, a centralized budget. Marcus brought up again the idea of SBs. What was it? Globes?
Globes.
That was the Globes.
But in our case, it's SBs. It was SBs. How do you assess the proposal to finance European public goods through European financing, a European public good being European defense or European climate protection or whatever? Can a genuine European fiscal capacity emerge as a result of the pressure to finance defense, climate, and so on? What are the pros and cons? How realistic is it, in your view?
Well, the closest thing we have to a European fiscal capacity, which incidentally, like many of the notions that we heard about as different interpretation, is probably the Recovery and Resilience Facility. So this was, and I remember, I think now I'm not revealing some secret, there was a closed-door meeting in which the then and current president of the EFC, in commenting the recently created ERF, he said, well, there are 2 views on this. Some seeing that the Hamiltonian moment, so kind of structural break. Others see it as something, a strict one-off and temporary device. As it happens in history, you get something because different people wanted having different idea in mind. I mean, this happens also to marriages, for example. But then, I think the same said, I don't know who is right, but I think one of the 2 must be wrong in the end.
Exposed.
Exposed, yes, exposed. So now some years pass, and when I see what has happened with defense, namely what we had was a defense SURE and not a defense RRF, I am tempted to say that those who saw the RRF as a one-off were perhaps more right than those who see it as the starting point of something greater. And in part, the reason of that is that, with all due respect to my friend and former Director General Marco Butti, who is very pushing on European public good, the RRF remain a scheme in which the choice on how to spend the money were still very largely national. Of course, with a broad conditionality, with tough negotiation with the Commission, at least especially for the member states where the transfer component was important. But in the end, the decision, so really it fell short of the public good model that one has in mind. Could defense provide the next frontier? Possibly, although because of the urgency of the challenge on the one hand. On the other hand, let's remember that defense is the domain to which, so intimately linked to sovereignty. So I suspect one of the reasons why the defense RRF was not tried is because there would have been, understandably, a demand for a stronger conditionality, but then member state doesn't want to be told really how to spend their money when it comes to defense. And we go back also to the point I was making, and also was making in the keynote this morning, that clearly the perception, let's not deny it, the perception of the threat are very different across European countries. So I have to say that I'm not, they call pessimist of the reason, so reason I don't see it. Perhaps a different scheme. Also, the EU is not really well equipped to that, because already, with SAFE, I think our legal service is very creative, so they find way to find new interpretation. There is an article of the Treaty of the European Union, 43.2, if I remember correctly, who set very strict limit on the use of the essentially it's a ban of the use of the budget with operation with military, with defense implication. Still, until 1 year ago, I suppose this would have been read to rule out SAFE. I suppose the legal services provided an interpretation that allows, that allows to circumvent, but clearly we are not the starting point. So I wonder whether actually, although I'm not in favor of intergovernmentalism, because we know one should think of a different setup for defense than building on what we have now.
But I think the point, so what is the Hamiltonian moment and what is the differentiating feature, right? So one issue is the fact, I think it was a Hamiltonian moment because it was an unprecedented borrowing at the EU level. That was the point.
For expenditure.
That was the second element. But I think when Mahmoud is talking about safe assets, or others are talking about safe assets backing capital market union, it's just a European safe asset. It's not the question for having permanent transfers.
Yeah.
So Markus is asking for SBs. SBs are basically backed, they're collateralized bonds, right? So this is debt from member states pooled. It's not a transfer scheme per se. So, and I think one should differentiate that. You say the advantage of pooled financing is relatively small, and maybe that's true, but we also know it has changed over time. But still, at least it would have the advantage of having a pooled asset there, a pooled safe asset, and that would be, I think, the functionality that we are looking for. Now, another question is, do you want to have permanent transfers? And then is the question, that is then rather the point, how much own resources can the EU budget have, and how do you want to distribute that? But I think we need to at least should be clear about the two different functions.
That's good. If you allow me just a point on this.
Sure.
This is a good point, but this reminds me of another point. Okay, Markus is no longer there, but I think we all read the paper on SBs. If I recall correctly, the motivation for the entire construction was something which has not almost mentioned in this today. So it was breaking the nexus between, the banking system and government. So this was considered a great priority in the wake of the experience of the great financial crisis. So this was the key, if one reads the introduction of the SB's paper, was the key motivation to make then a true banking union possible. We need to break this. The other day we had an interview with, just a short talk with Pablo, who was also here today. So Basel, I asked a question. Well, there is one missing thing about Basel, the regulatory treatment of sovereign exposure. Immediately reply, this is something I don't want to talk about. So, again, there are a bit fashion in the debate. Some things that are considered essential, and then since you cannot solve the problem, you declare, well, it's not really a problem.
Mahmoud.
It's a couple of points. One is, when I was at the fund and we were pushing for a central fiscal capacity, the motivation was different. It was macro stabilization. Now we have changed the language to public goods, the Draghi report, etc. Right? But the problem I think we did not face up front is that when you have a public good type central fiscal capacity or something, whatever it's going to fund, whether it's defense or not, ultimately it's about the EU budget and you need own resources, and for that you need countries to give up sovereignty. And I think that's the biggest challenge. Sure. The EU needs a source of revenue. If you're going to centralize fiscal capacity for public goods or whatever the current dilemma or challenge is, if you can't overcome that, and I think we didn't appreciate how important that issue is of own resources. And we were coming up with various tweaks and clever ideas, which weren't so clever at the end, but we didn't face that fundamental challenge. That if member states are not willing to give up some tax revenue that goes to the center, you are always going to be under the multi-annual financial framework, who's going to contribute what, etc. It's not structurally robust. I can't answer the question about will member states give up. The only time I've seen an example of this, which is kind of maybe still alive, is the carbon border adjustment tax, where there was an idea that some of this revenue would go to the center. Right? And the center then, if you put the center with some stable revenue source, then you can entertain ideas of whatever political choices you want to make about how should we spend this money, what's the current challenge. I think that's my reading of the contribution of the Draghi report. Whatever his shortfall is, I mean, the amount he's talking about in that report of common borrowing is relatively small from the big challenges that he's pointing to. But I think that's an important point to make. And just one final point is, I think Lucia has pointed this out, really. I say potential growth. When I look at Lucia's table, when he's showing us probabilities of debt stabilizing, I'm sure in that calculation you have the same potential growth that I have in my head, not kind of real numbers, but we're not changing it, and that's where debt sustainability calculations and the probability of stabilizing debt is coming from. This is my worry.
Perhaps to build on your comment, I think the problem is, of course, member states over time have to give up sovereignty to some extent to make sure that Europe as a whole unleashes its potential. The problem is that for the time being, whenever you talk about fiscal capacity, you're talking about transfers. You're not combining it with, we want to do something in common, but you talk about, I want to redistribute the funds along certain lines. And I feel a bit the same pain we have in Germany when we talk about our transfer system between the states, where you get the feeling, and in the end, there are some that think, now we will have to pay for the others to spend. And I think this to overcome probably the crisis or the threat is not felt to the same extent, or we have not explained to how do we really want to, for what do we want to spend it? For me, defense would make perfect sense, but others are probably saying, I would rather like to keep that to my own. I don't know. I'm a bit depressed at that point. But the argument from we need to support here and there, this will not get you to really coming up with a joint budget.
I think maybe on that, two observations. The first is with the challenges that we have, part of the problem, if you think about the EU budget, part of the problem is taking money that is seen basically as an appropriation and converting it into something that maybe can be used more flexibly and it's not a permanent transfer. So if you think about, for example, with SAFE, with defense financing, it's project related. It's kind of, but that means per se there is an end to this. So it's not thought to be kind of a permanent scheme. That is the one aspect, and I think that should also be acknowledged, and that can also hold for innovation projects and so on. The second point is that, at least in the defense area, but maybe also in other areas, you have the opportunity of creating genuine public goods in a sense that can be owned at the European level as well.
Exactly.
And that also offers opportunities, and you may do that in research. And you have a European Research Center, which is, so to speak, the liability and the asset is on the balance sheet of the EU. And then you are a service provider to member states. So I think in this context now that we are currently discussing, there may also be other options available than in the traditional use of the EU budget, if you think about that.
Yeah.
Okay, we have overstretched our time already. I still want to give the opportunity if there is one or two questions. Martin, please. Yes. So 1, 2, 3. Okay. And we take the 3 questions at a time, and then you have a final opportunity to answer. Martin, please.
Thank you. Thanks for this really fascinating exchange. I have maybe a comment on Lucio's presentation. I think I fully agree with the diagnosis, but I would have a possible alternative conclusion. You start by saying that sustainability is a directional concept, which I think everyone agrees, until you have to sort of document follow-through. And follow-through has not been the same across all the member states that we know. So therefore, when it comes to what we are observing now, the directional concept of sustainability is assessed differently by markets for different countries. So I understand this is also why, I mean, I'm not privy to these discussions, but from what I read in the papers, countries that have a very high level of debt, now I stress level, they are not so hot on, jumping on this escape clause, or so the directional idea that sustainability is a directional concept is true if it's substantiated by follow-through in praxis, and there we know that it has been very asymmetric. And that brings me to the sort of other maybe a conclusion or interpretation of what you said, which may then be a fairer attribution of responsibilities of what we observe now. The fiscal rules, as you know, have been implemented or established as a way, as a vehicle to supply a public good, a European public good. It's called financial stability or fiscal stability. Some countries have oversupplied maybe, others have undersupplied for sure. So when we now discuss the German behavior and what it implies in terms of yields, and I fully agree with Mahmoud in terms of level, it's precisely now this story. There is now also another group that has been oversupplying the European public good called fiscal stability, that now are using their fiscal space, and well, that has a cost also for the others who did not supply this European public goods, and where, if you want to be very harsh, just for the sake of the argument, have been free riding. So just in terms of balancing the responsibilities, rebalancing the responsibilities in this narrative. Thank you very much.
Thank you, Martin. Ermal? That was your question. Johan?
So in this discussion on European debt, none of you mentioned the fact that unfunded European public pensions exceed GDP 4 times. Is that because from accounting point of view, it's not debt, therefore it's excluded from the discussion? Is it because it's such a big problem, we're just not going to deal with it? Or are some people who suggested the European states are going to default on it anyway, so why bother discussing it? So which of the 3 is the relevant bit? Why is it ignored?
Okay, good. I might... is there any...
Here.
Yes, please, Giovanni.
No, just a question to Lucio, because this is actually something I was asking also yesterday at the dinner, but you made me reflect once further. Basically, what you were writing at the end about the possible interpretation of the escape clause as a way to guarantee TPI protection. No? Is this makes me again think about financial repression in the sense that is how much will be the pressure, and because if I look at the numbers, this seems a easy way out for many countries, for many, just to restart focus and putting pressure on the banking system to appropriate savings. I'm not saying that is happening, I'm not forecasting, but I'm saying that it's a possibility. And then can the fiscal framework allow, or the financial stability regulation allow this not to happen? Is just my question. I'm not asking you whether you have a reply or a solution for that, but it's just one thing that really doesn't keep me awake at night, but worries me. Yeah.
Okay, the IMF, as long as it still exists, has a question. The colleague over there, please. You are from the IMF, right?
Oh.
Moody's,
Oh.
Even worse.
Be careful with the answer.
now you need to be really careful what you say.
Exactly.
A very quick question. So actually, some keywords I saw from the presentations, especially from Rolf's and also from Mahmoud's remarks. So we are thinking about, in terms of priority, investment priority. So we heard about like climate, digital a couple years back, and now it's defense. Whether the priorities will change again for Europe in terms of spending, investment, whether innovation is still has some place there. So how to see those priorities in terms of investment looking forward? Thank you.
Okay, and final question for Jakob. Microphone, please. Because we have people online, they don't hear you otherwise.
No, I mean, I guess it was sort of triggered by, I think it was Mahmoud who talked about the financing cost and the repricing of markets, et cetera, to the German announcement. But I'm actually looking at the German 10 years right now. I just want to give a comment on the dumb luck of the Germans. The 10-year rate is now 253. It's up 5 basis points from before the announcement, obviously all due to Trump. And if we assume that this is, predominantly going into domestic demand creation, obviously defense and infrastructure, that will do far more to ease this savings and investment imbalance in the euro area than anything the capital markets or the savings larger than investment union will ever do. So why bother with the savings and investment union, quite frankly?
Okay. So with these 5 provocative questions, final round, or maybe I start with Mahmoud.
Okay, I'll pick some. On the TPI question, on the ECB, my assumption is that the TPI would be used in an environment of extreme stress. We're nowhere there, as far as I can see, right? I mean, we're not in that situation. The difficult questions for the ECB and the rules of the TPI, which are relatively vague, they'll face then. But I think the more important point with regard to any current sort of rise in yields and so on would be more for the ECB to slow down the pace of its unwinding its balance sheet, which would be much easier to do. And the ECB has never said, as far as I know, that it's on a pre-programmed part of unwinding. Okay, it can always kind of slow down and so on. I think that would help. That's one. On the question of yields, Jakob, you're right. Obviously, right. You know, this just argues for my point that global bond yields are very correlated. Bund yields are not higher now. But I'd make the more important point here that, you know, everything we've said today and what I was saying was about the impact of the German announcement. We have yet to see, this will take a long time, the 500 plus the 500, right? Defense plus infrastructure, that's a long-term plan. Multipliers, the impact on economic growth, et cetera, this is a very slow-moving process, right? So I don't see, for example, anyone raising their forecast of German growth this year. Maybe they will for sometime next year as we start seeing spending. I don't see any spending. The nature of the type of spending we're talking about, defense, etc. Then there are discussions about initially where will Germany buy more defense equipment from? Would it be current capital and how long it takes? It might not be from German producers, so the multiplier is not so strong initially. So these are, but I would come back to the point that global bond yields are, I mean, as we speak, I haven't seen it today, but, you know, US bond yields 10 years are below 4%, right? So, of course, we're going to see these correlations. And I haven't talked about tariffs, but the biggest impact clearly is tariffs and what it does to growth globally, including in Europe, right? So that's a much bigger issue right now, right? I'll stop there. So no.
Thank you, Mahmoud. Elke,
Let me
final
perhaps
word?
first build on the argument debt break and unleashing growth that way. First of all, I think we need to keep in mind it's a 10-year project. So we are not talking about giant amounts, and looking at all our red tape and bureaucracy around it, I first also want to see it really happening and not Luce at the end having the right answer to say we had a giant number and only little spent out of it. So, but for me, this is not an alternative to unleashing our capital markets. Unleashing the capital markets is a necessary discussion because this is a one-off. It's a one-off for the next 10 years, but it's not the permanent solution. And perhaps just to dare to answer, John, your question, when I think about pension schemes, unfunded pension schemes, I also think about the fact that we, at least in government, still have this money in, money out. We are not looking at infrastructure to be maintained and all of this in our accounts. But again, it's part then of our budget. I would prefer to have a commercial consideration of my budget to know what I'm spending, what my obligations are. But this is a long shot, not just in Germany. Yeah. And we are good, by the way, in creating other kind of debt, be it in promotional banks, be it in the like. So I think we have a lot to discuss there, how to relate the entire ecosystem.
Thank you, Elke. Lucio?
Right. Well, I think Martin made a remark. I think we mostly agree. Perhaps I should clarify what I meant. Yeah, if I understand Martin, he said, well, Germany has the fiscal space, is now using it. Other do not have. You have to leave. The problem, I was looking at the issue from the perspective of the idea that we should still have a fiscal framework. So, and having already the optics of unleashing an escape clause for 4 years at least, less than 1 year after you adopted the reform, are not very good. True. If at the same time the key country in the union say, you know what, until a few months ago we insisted on this and that, and now forget about it, and you will learn it from the newspaper. Well, used to say the newspaper, nowadays who reads the... If you see what I mean, it's not very good. There is in my paper, I quote, and you certainly know him, the view of some people like my friend Charles Viplot, that say, well, basically, what you need is a robust no bailout clause, and then you need homegrown fiscal rules. So stop pretending to having a fiscal framework. I'm still attached, perhaps, as I said, for biographical reason, to the idea of a European fiscal framework. And the way of doing it, it doesn't help, I think, the way the very unilateral way we can understand that the political circumstances, I think, is not helping to find what I still think is a necessary consensus on a reform fiscal framework. Maybe this is an illusion on my part. One thing on the pension, what I can say, I mean, there are many reasons why I think having this calculation of liability, pension liability, is not a very good metric. I mean, very sensitive to the discount rate, and then you can actually repudiate this liability. It's called pension reform. So it's a very difficult thing that. But I want to say that the calculation I was showing, which goes for a long time, do incorporate the increasing cost of aging. So to some extent, this is taken into account about the debt stabilization based on the current legislation. On financial repression, well, Sean would be more competent, but I think he has left. I think the fiscal framework, it is in a sense, is a logical conclusion. You want to keep price stability. You have a path of fiscal primary balances that may not be consistent. Well, you mind the bubble. One way of doing it is financial repression. I think it's pretty ugly, but it's quite a possibility. So in a sense, I find it a logical deduction, but I don't want to say more about this.
Final word for...
No, I would rather preserve my final words for concluding the conference.
Very good. So then I thank the panelists, Elke, Lucio, Mahmoud, and Rolf, for your contributions. Thanks for the questions. Sorry for taking too long, but I think we needed to get these things on the table and off our souls. So thank you very much, and over to Rolf.
So, then to conclude the conference, let me first also thank our co-organizers, Ernest, Jakob, Bruegel, and SUERF for this wonderful cooperation also from our perspective, and to everyone who helped with it. I think this was indeed a broad area that we touched, and I mean, many have said the topic could not have been more timely, or the circumstances more to the topic, and obviously this is with a view to geoeconomics, it's with a view to the US position. But we have not forgotten about the other key drivers, megatrends as well, climate change and also demographics, technological change, in defining what is actually the challenges that are out there for disruption. In that regard, I think the discussion went also beyond identifying the risks, but a lot also on what to do for Europe externally. And if I would kind of try to boil it down to the kind of the political recommendation is kind of be stronger and be more explicit in defining an external strategy in terms of what are the institutions that you want to keep, what are the institutions that you want to keep supporting, new institutions to create, Globis, is there something that we need to consider, but most importantly also what to pick your friends, what are the alliances that you want to create forward-looking. We have talked a lot about division of labor, what can Europe do internally, not only in this panel, but also before. For me, the gist when it comes to finance, both from the contribution today, from the contribution yesterday, Pablo's speech was basically we need a better balance, forward-looking on the possibility to support growth and to be safe. That we know we have done a lot in order to make the system safer, but we cannot avoid any risk. And how we do that forward-looking with a view to the new challenges, also AI, we have to carefully reflect on that. Let me open a square bracket. Pierre, when he announced, gave his speech, he announced a blog that would be published on geoeconomic risks and the financial system and how EBA and ESM look at it. That blog has been published this morning. I think it very nicely flows also with what we discussed here. Apart from the other areas of coordination that we touched in economic policy and in public finances and the pooling of resources, for me, one of the biggest takeaways from this conference is actually interaction with the political sphere. And we heard a lot about that and very useful elements. Key thing is we need to have a credible narrative. We need to have a credible narrative in Europe and globally in order to make it and in order to convince others. And as Klaus also has pointed out, this may be an issue of genuine, not only of being successful, but also of democracy more genuinely, because times will be tough and we will have tough choices to take in order to navigate it with a limited fiscal space on the one hand and a lot of risks out there. That is roughly my takeaway. I thank you all for contributing to this wonderful intellectual journey and wish you all a good trip back.
Okay.